fundsupermart.com.
What is your opinion on the fundamentals of China markets?
Actually following the leadership change in China last year, especially the late last year, and then actually currently the 2 weeks, this week and next week, there's an ongoing National People's Congress. We're actually looking pretty cautious, I would say cautiously optimistic on the Chinese market. I think we've seen a very strong era of growth in China, but I think with the new leadership, there's sort of a catalyst and new hope for sort of a next stage where they'll set the next stage of growth for China. So I think if you look at in terms of the economic fundamentals, a lot of the growth in the last couple of decades has spanned some issues in China. For example, environmental issues, corruption. So I think with the new leadership and a lot of talk about reforms and changes, if they get that right in terms of the execution, and if they sort of carry that forward, so I think the next few years will be pretty telling for China. But if they set the stage right, we think that actually the fundamentals for China, for their next stage of growth, which is something we expect to be more sustainable, so not at a rate that is too rapid for itself, but essentially something that's more, as they shift the economic model, one from an investment-led towards a consumption-led one, we think it actually holds a lot of promise for the economy. I think the stock market is always something different. So I think the interesting point is when you look at China, very strong economic growth in the last decade or so, but it does not necessarily represent strong stock market performance as well. And you can kind of see that in the performance of the MSCI index, for example. So from a valuations perspective, I think China currently looks interesting from a long-term investor's point of view. I think the last few months, markets have done very well. So, it's probably not the time to jump in immediately, but definitely if you think that China is on the brink of the next stage of growth, then it's now the time to actually keep an eye on the market to look for interesting entry points.
Consumption has been touted as one of the main drivers to boost the economy. Do we expect this trend to continue in the next 1 to 2 years?
For sure. I mean, we think consumption is a theme that will play not just for the next 1 or 2 years, but actually for the next few decades. Because I think urbanization continues to be a trend for China, and there are current policies where it actually limits or it actually restricts that urbanization. So for example, because of the existing hukou policy, there has been some limitations, as in it's not that easy for a migrant worker to move from rural to urban because there are restrictions as to how much healthcare benefits they get in the city, education for their children. But with sort of some thoughts on reforms and how the Chinese government is going to address some of those policies, I mean, including the one-child policy, for example. So as they rethink some of these and start to make changes, then we think that that actually sets the ground again for the urbanization theme to continue. And that what that means for China in terms of consumption is that you basically get rising wages. So you get rural workers moving to urban, and again, with those rising wages and therefore a different spectrum of consumption. So not just your food items and things like that, but essentially even your demand for housing, demand for cars, demand for cosmetics, that will continue to be the theme for the next couple of decades.
What is the reason behind the fund's portfolio allocation of 40% of its holdings into the financial sector?
I think if you look at the absolute weight of allocation to financial, it seems very large at 40%. But I think if you look at the benchmark, which is why we're saying when you look at the index for China, it does not necessarily proxy the parts of the market that we want to be in. But if you break down that allocation to financials, half of that would come from banks. In the case of our portfolio, but in fact we are underweight the banking sector, obviously because there are a lot of structural issues that are confronting that sector, which has been talked about a lot. So the thing is, banks make up a good close to 25% of the index. So to be completely out of that sector, to us, it's a risky call. So within that sector, we choose the names that are, we're much more comfortable in terms of the quality, in terms of their earnings. But we are basically underweight the banks. So that the banks would form about half of that 40%. But the other large contribution to financials is actually insurance. So we do hold quite a number of the insurance companies. And that's really still a proxy on consumption. So essentially rising wages and affluence. So the demand for be it insurance coverage, healthcare coverage, but also some of the investment or sort of insurance-linked products. So that's really again a play on the consumption story and the shift from an investment-led to a consumption-led one. I suppose the last bit, we also have some brokers, so diversified financials within that 40%. So again, these security companies, they're expected to again benefit from some of the reforms that are being thought about within the financial sector. And finally, there's property. So property was a segment that has done very well last year. We are currently underweight that sector, but we still have a bit of an exposure there. So all these combined, gives us the financials weighting. It seems very large, but actually within that pocket of financials, there are different themes that you can play within there as well.
How does the fund manage its currency exposure, and how does currency contribute to the fund's returns?
Actually, I think for us as a house, we don't hedge currencies when it comes to portfolio construction. So I think for a China portfolio, essentially, most of the fund is actually invested in Hong Kong listed. So in terms of, if you look at the Hong Kong dollar, it's essentially pegged to the US dollar. For the RMB itself, again, if we take a long-term view on Asian currencies, generally we think that they're going to appreciate over the long term. So what we tend to do when it comes to currency is really factor that into how currency movements, for example, impact the earnings of the companies that we invest in. So our analyst takes into consideration currency impact on the share price and the fair values that we value the companies at. But at a portfolio level, when it comes to portfolio construction, we don't actively hedge the currencies per se. But having said that, I think this fund in itself has actually a Sing dollar hedge share class, which allows for Singaporean investors to then have that sort of mechanism in place to manage the currency movements against the Sing dollar.
Thank you.